Coercive Capital is proudly supported by Hummingbird. Hummingbird is a modern compliance platform designed to make financial crime investigations smarter, faster, and more effective. Because today's financial criminals are sophisticated, savvy, and agile, meaning the tools used to fight them should be too. Learn more at hummingbird.co. This is Coercive Capital, where we expose how authoritarian influence, illicit finance, and dark networks reshape power in the 21st century. I'm your host, Elaine. Today's guest is Andrew King, Executive Director of Future Union, a nonpartisan organization redefining what democratic capitalism looks like in an era of foreign interference and shadow financing. Andrew and his team are behind the Clean Capital Pledge and are building a cross-sector solution to protect American institutions and capital markets from adversarial influence. This conversation is a wake-up call, not just for policymakers, but for every investor, boardroom, and civic leader who thinks the system is still safe by default. So let's get into it. I want to start with a quote. This is from a piece that Andrew recently published. Quote, "China has relied on Western capital to turbocharge its rise, exploiting investments to gain access to cutting-edge technologies critical to its geopolitical ambitions. The minimally regulated private equity and venture capital transactions provide China with the networks, expertise, and funding it needs to dominate fields like artificial intelligence, quantum computing, and biotech." So let's get into it. Why clean capital matters and how Andrew is building Future Union. Andrew, welcome to the show. It's great to have you.
My pleasure to be here. Thank you very much for having me on. Really excited to do this.
Well, I've been wanting to do this conversation for a while, and I've been following your work at Future Union for about 2 years now. So it's great to have you here, and I think the timing couldn't be better. As I know, there's a lot going on with Future Union, and I think this question about adversarial capital, as well as how the deep U.S. capital markets are leveraged for purposes that may not completely jive with national security concerns, that issue is really coming to the fore. So I want to start with how you catalyzed the creation of Future Union. What is it? How did you get there? And maybe talk about some of the major initiatives that are underway.
Yeah, thank you. So first and foremost, love that you're broadcasting all of the various areas that capital plays a role in sort of both the U.S. side of sort of the sword and then the shield too of strategic capital and a lot of the other entities that the U.S. government has set up recently. So Future Union was set up, I think, in a different era where government was still slower to come to the problem of capital in the competition against China, call it the COVID days. And so looking around with some friends as I was a venture capitalist in DC, sort of realized that the capital markets and private capital in particular that's less heavily regulated and more opaque is a primary source of access and influence by China, and they've been leveraging that for years. And so, unfortunately, a lot of the U.S. investors, before this became as apparent, were complicit in this, whether knowingly or not, because they were taking capital from investors from China and other places, or sort of working on behalf and providing information that came back through those sources. And so I think we've gotten a lot smarter in the last couple of years. Thankfully, these sorts of programming and knowledge and mainstream awareness has gotten out there through a lot of the mainstream press as well as the alternative options. But anyway, the idea was to try to get the private sector to take a larger role in standing up to China and other adversarial countries that were undermining the rule of law and the open and free markets that we all rely on. And so what we did was we looked at it from a bipartisan perspective and encouraged, catalyzed the private sector to do more. And so that flows into a lot of different areas.
And how are you structured? Are you a 501c3 or what is your kind of legal structure for the work?
Yeah, so we're structured an LLC organization. We have both a nonprofit and a for-profit aspect to it, and then we work through both entities based on sort of the goals at hand. So all privately funded, no intermingling that comes from any of the various sides, and basically set up to achieve goals that maybe other interested parties, like the for-profit entities and some that we'll talk about on the programming, may not have the same ability to take stances that are either unpopular or not profit producing.
Do you think you could kind of describe it as a collective action effort then of primarily the private investment community? And that you're, just to be clear, you're sourcing most of your funding from the financial institutions, financial community of interest?
Actually, it's all personal. So we don't have any funding from any corporates or anything along those lines. So everybody is an arm's length, and frankly, nobody has. There's no intermingling or um, uh, uh, discussion about anything that we sort of put out there beforehand. And so, yeah, I mean, I think that's probably the best way to put it. The idea was setting up something that leveraged the private sector because, frankly, we weren't hopeful at that point in time that the government was going to get to the point that it was making and taking the steps that were needed to basically blunt China and a lot of the central decision making of adversarial countries in a way that sort of reduce the risks in our free and fair markets.
How, how do you define this concept of clean capital? It's something that you've talked about quite a bit. I think there's some momentum around this idea. I think it's core to what you're defining within Future Union.
Yeah, and clean capital first and foremost. Definitions are difficult, especially in this area, as you know, because you've talked enough about this and excellent programming. But the idea is tracing back capital to the impetus of the source and ascertaining and sort of identifying interests that would be against just for sheer profit making type endeavors. And so the clean capital idea was sort of an underpin of we say the right things about where capital is coming from, but frankly, when you purport to be for profit and capital producing, maximizing profits, but then in reality, China and a lot of other adversarial states, but mostly China, has been responsible for posturing one way and actually really looking for insights and access through other means. And so the idea was to trace this back to the actual underlying entities where the capital is coming from. And oftentimes there's shell corporations and entities and LLCs and trusts and all sorts of other stuff that money passes through. And frankly, it's very difficult, even in the day of AI. Figuring this out is probably one of the biggest challenges the government faces. And I have yet to see a solution that actually works. And so one of the things that we're doing is we started with a self-attestation, which the companies that most of which and the funds that you would know have sort of self-identified. And, the next phase of that is actually going to a legal perspective of legal requirements and legal liability for knowing your customer. And obviously the know your customer type endeavors have been in banking for a long time. But that being said, we're taking it a step further and going back to the underlying source that the banking industry, frankly, is a little reluctant to try to take steps to look into.
Yeah. Yeah. So this idea that you've put forward and have been pursuing around a public investor pledge, instead of just focusing on policy, it seems to me like you want investors to have real skin in the game, right? Is that the idea? That you can have more traceability, but also that there's some level of accountability within this kind of this frame of clean capital.
Yeah, and I mean, I think you identified it. It's not just accountability. I mean, it's self-identifying right now, but the point is that when this clean capital initiative, the what's going to be readily apparent, we hope, is as more funds adopted, as more private investors step up, and we have more traceability than we've had in the past. That's going to unleash a greater amount of knowledge and awareness that hopefully we have a decisional structure where investors can choose between clean capital that is certified and capital that is uncertified, so that when you're looking and making decisions in a certified manner, you're going to trust that, or maybe there's less risk for the investors as well.
And what have you found in terms of sector exposure to authoritarian linked funds? Are you finding that certain sectors are much higher risk, or that certain institutions are maybe unknowingly vulnerable?
Yeah, there's a couple different ways to unpack that. From the standpoint of sectors, I think if you look at what are the riskiest sectors from using capital as a means to leverage and access, there's undoubtedly some sectors that are more at risk because they're higher value targets by China and other adversarial countries. That in particular means that obviously AI, with everything that we're seeing, is top of mind for everyone. And I think Mantis and the benchmark conversation with investing in Mantis, which was a Chinese AI company, has kind of sparked some of the backlash against that through the mainstream. That wasn't just investors that knew a lot about clean capital. But that being said, outside of direct investments from U.S. venture funds like Benchmark that have invested in Chinese AI leaders, the reverse is also true, because you have the Chinese LPs that have gotten information and access through the quarterly distributions by venture funds back to them of information. And even if that information is not as detailed, you get that quarterly and it adds up, especially with the siphoning of information that China has done across basically all aspects and all verticals. Their ability to assess data, combined with some of the companies like TikTok and information that they've received from basically a lot of the open source type areas, all of that combined gives them best practices, insights, and knowledge on how to build better startups or innovate faster than the US, which is problematic for obviously a number of different reasons.
One thing that I have really liked about the evolution of your work is this link that you've made between democracy, free markets, and national security. How is that playing out today? You talked about the fact that you launched Future Union during the COVID era, and we're really in a different conversation now, particularly as we look at the reorientation of global trade, the way that, for example, the tariff conversation is now entwined with national and economic security objectives, but in an environment that I think is more transactional than it is driven by democracy or democratic ideals. But how do you see those links between democracy, markets, and national security? Are you getting traction around that?
Undoubtedly, we are. I think the world is changing, and obviously the conversation around tariffs and what it means to be in the U.S. and an allied country versus Europe and an allied country, or NATO and an allied country, is adjusting the definition of democracy. We see it on the front lines with Ukraine right now, but you also could say, from a lot of the cyber attacks that sort of fly under the radar, there's a lot of countries that are at the precipice of sort of capital and the conversation with economics. Estonia, cyber attacks there, and a lot of countries that you would never think of that have been victims of China or Russia intermeddling type stuff would be would be the ones that sort of come to mind. I think the mainstream, it's becoming much more apparent to the average viewer and the average person in the street, which was unheard of, call it 2 or 3 years ago, 5 years ago during COVID times. Now the conversation is changing into how do we use capital and how do we use our free markets to win the competition rather than to be an Achilles heel in a competition that we didn't even know we were competing in. And I think that's the biggest thing. And we'll have a couple more things that are coming out in light of that, catalyzing capital to make a difference in sort of the global competition.
Mm-hmm. And do you feel like you're getting good bipartisan traction for your work?
Yeah, and I don't think it's just our work. There's a lot of people doing exceptional work out there on these issues. That's the really good part, and I want to credit the China Select Committee because they've been right there with us for a lot of this. And we went out with the venture capital funds identifying, and they had subpoena power. So obviously, maybe we took a broader approach, and they took more in-depth approach, even if it was voluntarily getting information from some of the worst offending venture funds, 5 which they identified last year, and so have worked closely with them. But I mean, I think when you have a congressional committee that has been renewed now once with a much higher budget, that goes to show that bipartisan interest in this cuts across party lines and really is throughout Congress.
And what about the potential for a more international focused effort? I know most of your work has been U.S. based, but if we look at what's happening in Europe, the potential to align some of these policies, particularly with European allies and partners, they also have relatively deep capital markets. Are you finding that there's interest in other parts of the world?
I would say there is undoubtedly. I think the difference is they're still later to the game than we were, from both a mainstream perspective as well as a defense perspective. And so a lot of the conversations that have come with the new administration have required a rethinking of what defense means and who we're going to rely on. In Europe, where I am right now, we're actually having those conversations real time with some of the major governments around this because the sentiment has changed dramatically. And I've had a lot of conversations around specifically the reliance on the U.S. and the ability to rely on the U.S., as well as, what does the future hold for us? And so I know President Trump and NATO and the 5% GDP pledge to defense budgets, a lot of that being infrastructure, is making a difference, but much more has to happen. And specifically, I would point out Germany in large part because I sit in Frankfurt right now, and in the Frankfurt, talking with a lot of the financiers, the $651 billion that they've pledged to defense over the next 5 years is unheard of. It's something they've never done, and frankly, I don't know that they know how to handle it yet. So there's still baby steps in that. And what it could turn into is, in my mind, it goes one of two ways. It becomes an infrastructure project to improve Germany. Mm-hmm. Or it becomes truly innovative and is, as intended, portion goes to improving some of the infrastructure in Germany, and then a large portion goes to both offensive and defensive security for Europe and NATO.
Yeah, absolutely. That pivot in Germany around defense investment is, I think, transformational, and has the potential not only to build out that base in the different ways as you've alluded to, but their economy is so dependent on China. And I mean, they have the dual challenge, and we've talked about this in other segments on this show, but the legacy reliance on Russia for oil and the legacy reliance on China as a primary export market is a double whammy when it comes to authoritarian challenges. And I think this is, sort of widely understood at this point that this is a particularly problematic period for Germany. But I almost think that this NATO imperative is the push, right, to move them into a completely different space. And I spent a lot of time in the Saarland over the years and other parts of Germany, and that industrial base has shrunk. Right, we always think of Germany as a serious powerhouse, and it is around manufacturing. But there's also, I think, a real imperative to think about what's going to be next, and where they go with that capital. So I think it's a really interesting time, actually, to be bullish on Germany in particular. But as you said, I mean, it's not going to be easy. There's a lot of capital at play and some big decisions that have to be made. So it's going to be interesting to see how that works out.
Well, following up on that briefly, I think spot on. I agree with everything you said, except for the fact that one thing is I don't think it's self fulfilling that they will make the right choices just yet. And I that's one of the reasons that I'm out here sort of having conversations I am. And I think there's a much more thoughtful process that's going into it. But some of the unforced errors that have occurred in Germany over the last decades are self-inflicted, and those don't change very quickly. And frankly, the mainstream perspective of what they face is still allowing them to sit on a fence, and it's a fence that you know very well and you've covered. But that being said, it is a fence that they've elected not to take a dramatic move in either one direction. And so if I walk out the door here and go to the Galleria that's next door, I find a DJI store for drones right there. Block the other way, I find a Huawei store. And so that in and of itself, in the dead center of Frankfurt, is, perfect example of them not having had or been forced to make difficult decisions that America has to make now. And what they do next will decide, it'll decide a lot more than just what happens in Germany.
Yeah, I think that's exactly right. And there's such an opportunity for harmonization of policy between the US and Europe. I think it would be incredibly powerful. I was thinking about the America First investment policy. We had a segment on that several months ago, and I know you've written on it. But I wonder if you see any inkling of a conversation in Germany about adopting some of the basic tenets of the America First investment policy, limitations on the opaque investment into Germany that ends up reinforcing exactly what you've said, their telecoms and drone manufacturing base, which is already dominant.
I mean, there is some of that, but I think, like I said before, we're so early in that discussion here compared to the U.S. We're 5 years behind. I mean, everything that I've seen, nothing has changed my perspective to think that Germany sits where America did during the COVID era, and what they decide next will have dramatic implications. And frankly, it's in the best interest of everybody for them to side with the allies on this. But I think until they feel that there is a reason to do that, that funding that they've allocated may languish. And there's a very easy decision or I think recognition that frankly not making any decisions is a decision in and of itself. And so if you look at the history, and I would say the same for the US, but we punted on a lot of those decisions for years in Congress and elsewhere. We still punt in the financial markets, as you cover all the time. And Germany, until they're forced not to kick the can down the road, in my mind, will probably continue that path. And so I think strong leadership is needed. And I frankly think the complacency that persists everywhere that I've seen, and there's a lot of cultural reasons for that, will dramatically have to change. And that might only come with challenges that are that they're reacting to rather than proactively, embracing.
Yeah, I think that's a really accurate summary. I would share much of what you've laid out. Hopefully, we'll be able to look back in 10 years, 15 years, and see that the catalyst around NATO funding was the starting point for a shift that will be beneficial for Western democracies and U.S. engagement with Europe, and kind of reframing and reshaping the manufacturing and productive base of the future. I think that's really what's at stake here. But as you say, there's a ways to go on the conversation. Hummingbird is a compliance platform that's reimagining what's possible from financial crime investigations. Teams using Hummingbird work more efficiently and effectively without compromising on quality. Investigators quickly get to the heart of each case with information at their fingertips and compliance-grade automation and AI to boost productivity. Designed for essential work in anti-money laundering, anti-fraud, customer due diligence, and more, Hummingbird allows you to customize the platform to your policies, giving you exactly what you need to get the job done. Hummingbird is determined to fight financial crime by empowering those on the front lines, because financial crime never stops evolving, and neither should the tools you use to stop it. Learn more at hummingbird.co. That's hummingbird.co. I'd like to maybe move into a different aspect of the conversation and talk a little bit more about some of the real world examples of how capital exposure is problematic. And I thought maybe we could start with the recent cattle IPO. You've done some writing on that and have talked a lot about it. And I was wondering if you could just kind of walk us through that particular case. Cattle, a major supplier of battery technology, lots of vertical integration across that company. They're really a global leader. It was part of what we looked at in the battery supply chain report that we launched just a couple weeks ago at FDD. So can you walk us through that particular case?
Yeah, frankly, it's one of the best examples of why we're not out of the woods, I think, in the sense of even America. And so while it's easy to throw stones in different places and at different entities for not making difficult decisions, we have to look in the mirror in America too, because a lot of our corporations, and specifically in the financial area, are still getting a pass. And so cattle is the prime example. Maybe technology, TikTok could be the one that we talk about there, and we continuously just push that ban or I guess the separation between the U.S. entity and the not U.S. entity down the road. But I think with cattle is the largest battery maker by far. Supplies Tesla, Volkswagen, a lot of the major car companies with their batteries. Not the most advanced technologies, but that being said, we've looked at the intellectual property and gone pretty deep into this, and frankly, the leading market share that they have, give them a huge benefit to be a market maker, and then combined with a lot of the subsidies that they've gotten from the state and in China's interest in various ways to help facilitate their rise, has sort of been transformative. So the cattle story is long dated. They've had, as I said, relationships with all the car makers at different points in time for batteries and supplying that. They look to raise more capital after listing on the Chinese stock exchange 5 years ago. And so they looked at doing a U.S. listing. In this climate, it's not as palatable. And as an ancillary opportunity, they looked at the Hong Kong exchange. And so when they started looking at raising, call it $5 or $6 billion in capital in the Hong Kong exchange, they looked at book runners and investment banks to do that. The two investment banks that came out of the beauty contest, which banks tend to do for any sort of a public market listing, and they're very lucrative, were JP Morgan and Bank of America. And the two of those led a deal that included a number of other banks too, but they were the ones that were at the very top. And so call it 2 months ago, they were able to use the the placement agents of Bank of America, JP Morgan, and others, Goldman, Morgan Stanley, a number of others, to get listed on the Hong Kong Stock Exchange with a number of waivers that came directly from the Chinese government to be able to facilitate that and also keep intellectual property and patents opaque and, frankly, from investors, increase the liability risk if anything does go wrong with the company or there's a separation issue. Because, as you know, the Chinese government has a right of basic first refusal, an overarching right on the technologies of any Chinese companies and the data. And that persisted. And in the US markets, the SEC would not have allowed that, or at least there would have been more constraints. And the Hong Kong exchange was willing and able to give them very quick waivers to get around that.
Yeah, that's a big problem. And do you think we're going to be seeing a lot more of that sort of arbitrage, if you will, kind of moving into these jurisdictions to promote certain kinds of technologies, advance the interests of the CCP through these entities that are ostensibly private, but really operate with a high degree of influence from Beijing?
Yeah, I mean, the one thing that we both have to call out on this is the golden share. So China has been, the operative entity for creating a golden share, which basically gives Chinese authorities or CCP, Chinese Communist Party members, a seat on the board for a negligible amount of money, but basically gives them almost a blocking right on a lot of the major corporate decisions, plus an interest in capital or profit that may come out of those large listings. So again, despite China being, a centralized government, a lot of those party members make significant amount of money in the success of these Chinese or U.S. stocks that have Chinese investments down the road. And in other places we would call that. I guess the best way to put it is trading on insider information is one of the things that's going through Congress right now. And everybody's looking at the Senate and House and what we do with our own insider trading. Insider trading in China is much more prolific, and it doesn't even have to be hidden. So I think going down the road on arbitrage, it's not so much an arbitrage issue because it's a new pathway for China to list its private companies publicly. This happens to be an instance where cattle was already listed on the Chinese stock exchange, so it's not an IPO; it's a secondary listing, but happens to raise $5 billion. And there's a lot of nuances in how that deal came about. That the China Select Committee has issued subpoenas to Jamie Dimon and Brian Moynihan at JP Morgan and Bank of America last week to try to figure out and discern really what went on behind the scenes. But a lot of our writing has been on that. And but the simple fact is there was 60, a week after that listing, there were 60 Chinese tech companies that were looking to list on the Hong Kong Stock Exchange. Now it's got to be upwards of double or triple that amount. And it's a new pathway on the backs of the banks and their reputation and the signaling value to be able to a new pathway to unlock money, which frankly, with our M&A markets and IPO markets, they're unfreezing now, but largely have been stuck for the last couple of years. It's an unfair advantage for the Chinese companies that otherwise are getting liquidity and investors that are getting liquidity to do the next step or grow faster, which U.S. companies aren't really eligible for.
Right. Yeah, I mean, this is another example of weaponization of free market practices. That's what I think this is. Maybe that's the way we need to start really talking about it. These components of global finance and global trade have been weaponized to a point where we've lost our ability to control it in a way that supports the free market principles and this separation of public and private. The lines are becoming so blurry. I mean, in a way, it's the same challenge that I think we're about to face with the Hutchison Ports deal, right? I mean, we're coming in from a different entry point there in terms of, U.S. investor coming in and, with a European partner, which is actually a very good thing, but now pushback from the CCP and their insistence that the deal can only go forward if there's the inclusion of Costco, right? A major Chinese port terminal operator. Why? It's for the exact same reasons that you've identified, right? Um, this is going to be a real issue. How do we go forward? Can we even allow something like that from a national security perspective?
Yeah, I mean, your guess. I mean, I think we know where we both stand on this, but this is sort of a question for the business community too. And when are they going to start taking, a principled stance on this? Because frankly, this is not going to age well as I look at this down the road. And do you want to be a Jamie Dimon, Brian Moynihan outside of the pay packages in looking at where you stood on some of these issues when they were important, rather than hindsight when we know what they led to a year or two or more down the road. And when those companies are receiving subpoenas by purportedly bipartisan commissions that are focused on what the American people care about and frankly have been getting a lot of attention, um, again, a lot of CEOs can weather that, but that's still not the right stance, I don't think, for the future.
I'd like to pivot back now to the US and talk a little bit about university endowments and pensions, where there's been a growing discussion around exposure of endowments and pensions, in particular to what's going on in China and investment strategies that might put them at risk. Andrew, I know that's an area where you've done a lot of research and writing. So give me your take on that.
Yeah, I mean, we've outlined this in a couple papers starting last year, and I think pretty good handle on the industry or exactly what's known and what can be identified. And as we've alluded to in some of our writing, I mean, over the last couple of years, the last five, $68 billion has gone to Chinese venture funds or funds investing, U.S. funds that are investing in China in some way in the innovation ecosystem. And that's the way that we defined it is, the public markets are a lot less contentious because frankly, that's more mature technologies. And even if that's a public listing on a Chinese stock exchange, Hong Kong aside, and the waivers that came about that, it's usually much more mature technology. But investing in the early stage startups or the innovation ecosystem that basically propel a lot of these technologies, be it quantum and AI, biotech, um, even drone technology that we've seen that basically has a dual use, or DJI has proven that you can do military and consumer at the same time. I think this capital has been the biggest Achilles heel that we've had over the last couple of years, because basically it's not just the capital. And if it were just the money, it would be a lot less of an issue. But it's the know-how of the venture funds that are the top ones, oftentimes in Silicon Valley and in the U.S., that provide access, but also provide the informal networks of advising the startups in China and others on how to outcompete the U.S. startups that are in similar verticals. And the way, as a venture capitalist, the way that we work is you don't invest in competing technologies in your portfolio. You put all your weight and your might behind one winner. And that's the critical part. And if that winner, if your backing goes into, let's say, a Mantis at Benchmark in China, you do everything you possibly can to make sure that that startup wins the whole competition against all the rest, because that's how you exit, that's how you make money. And it just so happens that what you're doing is, it's not just an investment, it's basically at least at Benchmark, decades upon decades of the brightest investors in the US ecosystem that are the most connected, putting their Rolodex or I guess LinkedIn accounts these days behind those companies to ensure that they win. US companies don't.
So let's go a little bit deeper on exposures of endowments and pensions. Where specifically have you found the most risk? What kind of exposure are we talking about? Can you get into some of the details on that?
Sure. I mean, there's some pensions and endowments that are more noteworthy. Oftentimes, the larger ones. So, the at least let's back to basics or taking a step back here. U.S. pensions or state pensions. We don't. The U.S. at least until a couple months ago had never had a sovereign wealth fund. So, let's say Norway and Sweden and Saudi Arabia and China, obviously, have large sovereign wealth funds where the government takes money and decides how to allocate that for economic outperformance or reinvesting on behalf of citizens. What we have in the US are US pensions at a state level that take government workers, oftentimes police, unions, nurses, teachers, others, and that goes into a state pension fund that then reinvests because they have to keep up with the payouts that come as people retire later in their career, obviously. So there's always this catch up type endeavor for pensions to try to outperform the market, or at least recap. And so oftentimes, what the venture capital and private equity community, the private markets, have been the best at is actually taking on greater risk, but also greater rewards. And so that's always sort of the impetus for doing a lot of the investing in private markets that are more opaque and less liquid. There is a greater risk of loss, but there's also a greater risk of significant returns. And that market has shown over the years it can return a lot of money. In the Chinese market, when the government basically puts their thumb on the scales of who wins and who loses, because that's what happens in China, they basically allocate siphoned resources from intellectual property theft, cybersecurity theft, others to individual national champions, be it an Alibaba, be it a TikTok, you name it. And oftentimes those outcomes are much more dramatic. So the question of investing in China is not so much of picking the winners and losers. Oftentimes that's pre-decided and predetermined. It's getting access. And that's why the venture capital and private equity community, especially the most connected one, has fought significantly to get access to that market in whatever way possible. And so the pensions have sought the greater returns, certainty in the past of investing in basically a rigged system of China to reap greater returns. And so what's happened is the largest or oftentimes the largest investors like Sequoia, we saw Benchmark with Mantis. Historically, Benchmark has not been one of the worst, but the us and the select committee for the CCP identified a number of the major players that had gotten much of the pension money to go invest in China. And so the pensions have provided upwards of tens of billions of dollars that has gone into the Chinese markets, and thus gotten good returns if they could exit. But that being said, it's become much more challenging without an IPO market. And so what we found is some of the largest pensions, like the New York State pensions, the California state pensions, frankly, Texas and Michigan, have been some of the worst offenders, have funneled billions of dollars into funds in China that have basically supported and built innovation ecosystems. And so the other side and the flip side of that is also the endowments. And those are the universities that we know that they get their money from a combination of wealthy individuals that are donors that provide money either at death or prior to death to facilitate funding. And Harvard obviously is one of the leading ones that's gotten a lot of recognition for about a $50 billion endowment. But oftentimes they've been some of the worst offenders, and they don't have the transparency requirements that a state pension would have. And so from our investigation, we found tens of billions of dollars also going from the largest University of California system, University of Michigan system, University of Texas system, and then Yale, Princeton, a lot of the other major universities, despite being very opaque and difficult information to find, are some of the worst offenders investing in call it dozens to upwards of 100 startups in China.
Mm-hmm. Do you also see it in terms of exposure to China's sovereign bonds?
So we really haven't looked at the bonds nearly as much. It's an interesting area to look at. I think the challenge for us is the bond market is a very different market than the private equity and venture capital. And I started out actually at Citigroup in the bond market. I think in my mind, still very problematic, but a very different analysis and also different types of players than what we're seeing in the venture capital and private equity space.
I do think there's something there. I wrote a piece on that a while back, and there was a pretty fundamental decision made back in it was 2016 or 2017 to allow Chinese sovereign bonds into the benchmark, the MSC benchmark, and that really opened the door for this exposure in a different way. The only person that really called that out was Marco Rubio, to his credit. Um, yeah, yeah. I mean, really big kudos to Rubio for taking a pretty principled stand on that. I do think it's something we need to take a deeper look at. It's just, when we think about where we're going on the trade conversation and the exposures, right? It's not just exposure to um, Chinese exports; it's exposure to these tangled webs, right, of investment that are really challenging, and going into essentially a trade war, right, without maybe having thought through all the implications of these areas of exposure. But also, big shout out to the Select Committee and the CCP for being, I think, a constant source of, raising the alarm bells and looking at the right aspects of this problem. But maybe that's a good segue into the resistance. What do we do about this? You've touched on some of the potential approaches and tools. But the first thing I wanted to ask you is what kind of traction are you getting around the Clean Capital Pledge? And what would you define as successful? What are you looking for there? How much, what percentage of engagement do you want to see from the investor community around the Clean Capital Pledge?
Yeah, a great question, and frankly, following up on sort of like the previous one on the MSCI and some of that types of stuff. The politicians, frankly, on that issue have been very good and bipartisan in basically calling out some of that exposure. And frankly, your piece was excellent on that. And I think, especially for the federal employees, that was one of the sticking points of allowing basically our federal pension fund, significant for all public employees, to be allowed to invest in Chinese bonds, equities, things like that. And that's something that voluntarily, I give them credit, they've stepped away from, or at least proverbially stepped away from. But getting back to the Clean Capital Pledge, what we're looking for now is more international investors. So a lot of the private funds. So as we talked about before, not only are we seeing with the Europe being farther behind in a lot of different areas, we're also seeing a resurgence of new interest in this area, and that means more funds are taking a second look at it. So I think we had the COVID era of ESG, and that is still here in Europe and pervasive, and a lot of the restrictions on offensive weaponry and national security investing are still prolific. So a lot of the institutions are still prohibited from investing in things that would necessarily improve the future predisposition defense of a lot of the European countries. That's slowly eroding, but it's still not fast enough. And so as that erodes and there's more money that can go into some of those private capital funds, the venture funds, private equity funds, and things like that, I think you'll see greater ability to invest. And frankly, what will come with that is where you're taking money from. If it's a European entity or something that conforms to the Clean Capital certification, you'll see funds that are more eligible. Right now, I will say from a non-scientific perspective, most if not the vast majority of funding here in Europe has ties to China or has Chinese ties running through it and would be ineligible for the clean capital pledge. And I think with subsequent funds, as they raise new funds and there's more institutional capital to come in that frankly is getting outside of the ESG parameters and frankly has the opportunity to invest more holistically in national security to support, there'll be greater sources of capital, which will provide them an ability both to clean their capital base and then take part in the clean capital certification.
Do you think the movement around clean capital can scale without some specific legislation or more policy support from the US?
So I look at the model that I'm still very much a free market capitalist believer. I believe that government intervention should be the last resort, or relying on that should be the last resort for most things. I really do think that the idea of capital that is both certified as clean and championed as such is desirable from both the investment limited partner perspective as well as the investor perspective. And I think that scales on its own based on having source capital that is clean and then also investors that want that. And so you have basically a bifurcation of a market where you have, the good capital on one side and providers that either choose or cannot find clean capital for a number of different reasons on another side. And both of those winnow, or I should say the good capital widens and the deleterious capital narrows and winnows over time so that you have a base of good capital instead of a collective intermingling of both.
Yeah. And would you have any specific advice for investment committees on how they're vetting sources of capital?
I think, this is sort of like the Supreme Court's pornography challenge from years ago, where you sort of know it when you see it, and you don't need necessarily parameters for a lot of this stuff. You just have to basically be, you need to be vigilant in what you're looking for. And so when you have a limited partner, which frankly, every private capital investor wants more limited partners, you have to get out of the idea that you'll take capital from anywhere because it's capital and start looking at, like, proverbially, why are they giving us capital and where is it coming from and what do they want out of this? And for too long, I think we've neglected I should say those investment committees have neglected what has been obvious because they did not want to acknowledge what was obvious in where the capital was coming from. And I think there's a greater, if not principled stand, knowledge that other investment committees will be looking at that. And to keep up with the Joneses, we have to consider this more vociferously than we have in the past.
Great. Final question for you. What do you think success should look like in 5 years' time with the Clean Capital Pledge and the engagement of the investor community in your work?
Well, I mean, we'll find out because I think that's, we're trending towards this. But to be honest, I think one of the challenges that remains and something that I'm working on daily is greater tools. So frankly, if this clean capital pledge that starts as voluntary this year will go to something with legal liability because it will go through a law firm, and there will be consequences for bad actors. And I don't think we have any of those right now, but frankly, there are ways to game the system. I think the tools that the government is not prepared to provide yet, and frankly, even AI and leading technologists have not been able to crack, will give us greater confidence in a couple years that frankly, China is not intermingling. If there is Chinese money, it's going after pure profit motives instead of deleterious access, information advantages, which we've seen for years. And that in and of itself, I think, is a huge win.
Excellent. Andrew, thanks for sharing your time with us, and I wish you all the best with all of your work and the Clean Capital Pledge. It's really important, and thanks for taking a principled stand. I appreciate that.
Thank you for the time. I really enjoyed this.
Thanks. That was Andrew King, helping us navigate the line between capital and control. At Coercive Capital, we're not just following the money, we're decoding the new battleground of power. This show is part of the Illicit Edge Network, a platform connecting experts, investigators, and producers, tackling the hidden architecture of modern influence. If you want to learn more, support our work, or ask a question for a future guest, visit us at elicitedge.com or email us directly at elaine@elicitedge.com. Subscribe, share, and leave us a review. Every listen helps shine a light into dark money. Thanks for joining us.